Hi there, everyone. Welcome again. I'm Ross from Hive Business. Really pleased to welcome my chartered tax colleague, Simon.
Hello.
Welcome again.
Thank you. Hi, everyone.
Cracking. Really wanted to kind of spend a little bit of specific time today talking about IHT, it's abbreviation for inheritance tax. There's some specific reasons why we're talking about this, but also because sort of a bubbling larger trend that we think people should be aware of as well. So, Simon, probably first place, what is IHT? What is inheritance tax?
Well, in its most basic form, I suppose inheritance tax is the tax that your estate will pay, you will pay, your next generation will pay on the value of assets you have when you die.
Okay, there's a lot of kind of commentary about a wealth tax. It is almost like a bit of a wealth tax, though. So, the dynamic, I suppose, I'll kind of lead straight off with it. It's another tax collection from HMRC on assets you've accumulated that have already, you've already paid the tax on. Is that a fair summary?
Yeah, definitely. So, we've got tax everywhere you turn at the moment, haven't we? Tax when you earn, tax when you buy, tax when you die. Um, so, yeah, it's just it is a wealth tax because it's based on asset value.
Right. Well, what tends to happen? How come, this is bubbling to the surface more and more? How are people going to be, or how are their estates going to be subject to this?
So inheritance tax applies approximately 40%. There's some allowances, there's some reliefs, but it is based on the value of wealth in your estate. And the reason it's so relevant at the moment is because of changes the new Labour government have introduced. There's no longer very much that's not caught by it, and kind of coupled with this situation where assets are increasing in value. We've had inflation, house prices are increasing, whether that's your home or your second home. Everyone's dental practices are increasing in value. The cash they're producing is accumulating over time. These reliefs and all these allowances are staying the same. So over time, it's fiscal drag, isn't it? We've got more and more becoming subject to IHT because it's all worth a bit more. The big change from the Labour government announced in recent months and due to come in the next year or two is your private pension is now going to be caught by inheritance tax, whereas before that was kind of the one safe haven. Save a bit of tax by topping some money into your pension, and that ends up in the next generation tax free. That's not the case, or not going to be the case anymore.
Wow, okay. So I'll probably kind of pull that thread in a moment if that's all right. So can I get a bearing on it though? So you said you pay your estate, the pot of money, I suppose, itself pays 40% tax on death. Like what kind of on how much, if that makes sense?
Everything above 500,000 per person, essentially.
Yeah.
Possibly lower, depends if there's a house, family home being left to the family, but kind of
So
500K per person.
as kind of a standard family unit, if you've got and diligently saved £1 million worth of assets, that's the threshold. So probably kind of applying it quite practically, you could have a house which is worth 1 million, could be worth more, might be worth a bit less.
Mhm.
That's fine. But if you've got any other kind of savings, then you're gonna be paying inheritance tax on the excess over £1 million.
Pretty much, yeah, pretty much. Maybe a bit of other exemption for kind
How
of
have we
business
not kind
assets.
of Yeah,
So
so how have we not been kind of shouting about this prior then? Is that kind of a clue to the pension thing?
yeah, so the pensions is a massive change, but equally it's one of those things, no one likes to talk about death, do they? We're human nature, I suppose. It's a problem for the future, so we'll avoid it till the future. Um, and I think there's more of a lurking problem than people have been aware of, even before the pensions kind of come into it. We say £1 million house. Well, believe it or not, it's not too crazy these days to have £1 million house, whereas 10, 15 years ago, that was,
Yeah.
you know, different.
Not- Well, we estimate that house prices went up around about 25, maybe 30%, even just during the kind of COVID bumps. They maybe kind of
Yeah.
receded a little bit, but those kind of that property kind of index does keep going up. And not that I want to kind of use this particular video as a hallmark, but it's like it is a real thing. It's like where you could probably ignore about it and maybe kind of fumble through. Like it's really is it front and center? Are we talking about possibility of 75% of the audience being involved in this now? Is that what we're talking about?
I think so. Yeah. I mean, always used to be considered the one tax that you only paid if you were, maybe daft enough not to think about it. But I think that might not be the case moving forwards. If you're not thinking for it, at least being aware of it and planning for it, because it's also the one tax where planning can have a disproportionately large impact, as long as you're not leaving that too late. I just think we're moving into a situation where we should all be thinking about what our inheritance tax might be and what can be done about it, because there's still a lot that can be done about it, even though pensions are being brought in.
Yeah, okay. So very much kind of a behavioral change then, I suppose. You could probably ignore it previously. You maybe just about get away with it. Is there planning that you can do for inheritance tax kind of in later life, or is it how does the dynamic work?
There is, but inheritance tax has this kind of built-in 7-year clock that some of you may have heard of and be familiar with. But the obvious kind of thing, the obvious answer that immediately springs to mind is, well, just give everything away. If you've got nothing, you can't. You've got no wealth. There's no estate to be taxed on. But that needs to be done at least 7 years before the tax is due. So 7 years before you pass away. And of course, nobody knows when that's going to happen. So, you can't wait until you're elderly and suddenly fall ill to kind of then give the assets away and
Yeah.
wipe your brow and get away with it. It needs more kind of active thought a bit earlier in life now.
Yeah, okay. So there's this kind of it's the proactivity, I suppose, that we're always kind of talking about. Like, weirdly, never is it more important than with kind of inheritance tax planning, unless you're happy to pay the 40%. I suppose that's
Yeah.
the other kind of truism, isn't it? You can absolutely do nothing, but 40% or 40% over £1 million will be kind of washed through.
Hmm. Yeah.
Cool. So you have alluded a little bit to what's subject to inheritance tax in terms of it does include the family home. You mentioned pensions as well, and I will kind of expand that in a moment if that's all right. Like, what else is included? Is it everything?
It is basically everything other than business assets. So if you own a dental practice, for example, that is not included. It's a business. The government don't want you to have to force to shut a business so that a tax bill can be paid. So business assets are excluded. You'll all have heard loads in the news recently about agricultural assets, farms. There's
Yeah,
reliefs there. There's historically been reliefs there that are being rolled back a little so
yeah,
that farmland will start to become taxable.
yeah,
Maybe less relevant to a lot of our clients, but
yeah, yeah, yeah.
um,
But if you've
it's
sold your
part of it.
business
If you've sold your
and
business, yeah, you don't own a business anymore. Now you've got cash. That cash is subject to inheritance tax.
yeah,
Yeah.
okay, and other things that we're thinking about, stocks and shares,
Uh,
cryptocurrency,
yeah.
property.
And anything stock shares, crypto, property, classic cars, if you've got them, some people have invested in assets like watches and whiskey because of capital gains tax exemptions, but there's still inheritance taxes on those things. They are anything that makes up the wealth in your estate.
Wow. Okay. So massive. And then draw it, reel in the pension asset as well, which, for some people is pretty substantial. There's probably a bit of nuance between an NHS pension and a private pension, but I'll assume we're kind of talking about private pensions element of things. They're now in that net, aren't
Mhm.
they?
Yep.
That's the big thing. When's that kicking in?
I believe that's from April 27, currently
Okay.
scheduled for.
Yeah, okay. So really big problem. Kind of ironically, even more of a big problem because it's it might be a pension you're not even started drawing down on or anything like that. So what are you hearing people doing about the pensions thing? Because I think there's a natural reaction to kind of start panicking and taking action with that. What's the dynamic with the pension side of things?
I think maybe perhaps even more so than with some other taxes, it's very situation dependent. Some people are suddenly saying, "Well, why would I contribute further to my pension?" Others might kind of draw more out and spend it, use it what the government might say a pension is for. Others may decide to take no action or to take action on other assets, leave the pension as it is. There's no, I don't think there's a finite list of things you could do, but you need to do the right thing for you and your
Yeah.
circumstances and your collection of assets.
Okay, so let's just say we've got a viewer who has a private pension and they're looking at this now, kind of knowing it's coming in, or we have to assume it will come in. Massive amount of kind of vitriol for it. But as the fact of the matter is that the pension rules are coming in and they're looking at their substantial pension pot and they're thinking, Christ, well, if I do nothing, I'm going to be walloped by inheritance tax. Should I do something else? Should I draw it down now? How does that, what the consequences of doing nothing and doing something?
Uh, well, I mean, if you're drawing on a pension, you're paying tax on drawing on it anyway. So, it's definitely pay tax versus maybe pay tax if you leave it where it is. So it's not an easy, it's not an obvious answer in the wrong circumstances, I suppose.
So just to kind of be clear about this, so you're saying like we've got a pension.
Yeah.
Rachel Reeves has now said we're gonna grab 40% of that. So you leave it there, it's 40%, or actually maybe you're of a qualifying age where you can start drawing it down. Start drawing it down now instead, so Rachel Reeves doesn't get 40% of it, but actually Rachel Reeves gets some tax out of it anyway.
Yeah, and probably still 40%, maybe even more.
So real kind of double whammy situation there.
Yeah. Yeah, so it may be one of those things where actually the best thing to do is look at what other assets there are and leave the pension where it is. Or I, I really kind of can't describe what the best thing to do is. It's so case by case. And even two people with exactly the same situations may come to different conclusions on what is the right thing for them and their family and their lifestyle.
Yeah, okay, all right. What's the best thing people can do then? So, like, is it sit tight and do nothing? Uh, is it take some action? What are the kind of the warning signs that a viewer should be considering?
Yeah, okay. So if there's family wealth, I suppose, immediate family wealth or individual wealth, I should say, of 500,000 or pound, £500,000 per person. Husband and wife get to kind of share their allowances a little bit. Um, that you need to take some action. And that first step of that action might just be, well, let's find out what the problem is. Let's have a look at what are the assets, what are the liabilities, what might they be when we get there, what might the tax exposure be. I really can't kind of say beyond there what the action you should take next will be, other than let's find that out. Let's find out how big the problem is and what the
Well,
assets
and the other kind of essence I get from your guidance there, Simon, as well, is the route is really kind of case dependent, but actually there's a disproportionate outcome in taking the right path for you because like the adverse path is going to cost you 40%. So there's good proactive measures to be taken. But of course, is that kind of a fair summary?
Yeah, I agree. I think you've got that bang on.
Yeah, yeah. Wow. So actually kind of quite clear then. If as an individual your assets over 500k or as a husband and wife £1 million, really need to be thinking about this now. And ironically, even if you're younger, if you're kind of expected to grow that wealth beyond 1 million to 2 million, 3 million, 5 million, 10 million, it's kind of even more reason to take action and to take proper planning.
Yeah, it'd be a much easier problem to solve when it's a smaller number to solve rather than when those assets have grown to 10 million pounds, for example, then we've got a 10 million pound problem to sort out rather than a 1 million problem, 1 million pound problem that 9 million of that can be solved at the beginning. That growth can be dealt with now.
Right. Okay. Well, I get the kind of feeling there's some well-trodden paths to be taken here, but kind of can't tell you which path would be right for you. What's the best thing people can do?
Best thing to do, get in touch. We can help you compile the list of assets and liabilities that will let us tell you what your current exposure is, and then we can take that to the next step and work out what can be done about this potential tax liability. So yeah, get in touch.
Right. Well, thank you very much for explaining it. Yeah, any questions for any viewer? Does sound like it's worthwhile planning and considering. Thank you very much.
Absolutely. Thank you.